When to buy the dip. The bond market is still in the early stages of a bear market that could last several more years. History shows these downturns typically run 3 to 5 years, and we're only about 2 years into the current one. The last major bond bear market ran from 1967 to 1981, a brutal 14-year stretch where investors who bought too early got crushed repeatedly. This time likely won't be as severe, but the lesson remains. Timing matters just as much as selection when buying bonds. Have you ever jumped into an investment too soon, only to watch it sink further? That's the risk bond investors face today. Morgan Stanley's fixed income team has studied every bond bear market since 1950, and their research shows yields usually peak 12 to 18 months before the Fed starts cutting rates. With markets currently pricing in rate cuts beginning in late 2024 or early 2025, yields could top out between now and mid-2025. But in the 1970s, investors who bought bonds too early saw their holdings lose another 20 to 30% as inflation raged on. The takeaway: patience pays off when inflation isn't fully under control. So, how do you know when it's time to act? Let's break it down into a checklist of key indicators. Core PCE inflation. This needs to show sustained movement toward the Fed's 2% target. The latest reading of 2.8% is still too high. Job openings. These have fallen from 12 million to 8.8 million, but need to drop further to ease wage pressures. The Fed's balance sheet. The Fed is still shrinking it by $60 billion monthly, which adds pressure on the bond market. Each of these signals will help confirm when inflation is truly beaten and the bond market is safer to enter. Credit spreads are another critical signal. High-yield bond spreads typically widen to 5 to 6 percentage points over treasuries during peak stress. Right now they're at 3.5 percentage points, so we're not there yet. Similarly, investment-grade spreads above 1.5 percentage points often indicate serious economic risks. Currently, they're at 1.2 percentage points. Keep an eye on these levels, as they can signal when the market is pricing in maximum risk. The yield curve also plays a role. The current inversion between 2-year and 10-year treasuries needs to start normalizing. Historically, the curve begins to steepen about 6 months before recessions as short-term rates fall faster than long-term ones. Right now, it remains deeply inverted, suggesting more pain ahead for bond investors. Wait for clear signs of the inversion easing before making big duration bets. Other economic indicators provide additional clues. Corporate earnings revisions, for example, are still trending downward. S&P 500 earnings growth estimates for 2024 have dropped from 10% to just 3%, signaling more economic weakness ahead. When these estimates stabilize, it could mean the worst is priced in. Housing data is another early signal. Existing home sales have stabilized at low levels, but prices haven't fallen much yet. A broader decline in housing prices would indicate the Fed's rate hikes are fully working through the economy. Right now, prices are only down about 5% from their peaks. Finally, watch commodity prices and the dollar. The Bloomberg Commodity Index remains 25% above its 2019 average, and the dollar index is near 20-year highs. Sustained weakness in both would signal easing inflationary pressures. Similarly, bank lending standards and money supply growth are worth monitoring. When banks stop tightening and M2 money supply turns positive again, it could indicate the Fed is done fighting inflation. By following this checklist, you'll be better equipped to time your bond investments and avoid the costly mistake of moving too soon. The bond market's warning lights are flashing red, signaling risks that have preceded every major financial crisis. But here's the opportunity. Investors who act now can position themselves to profit. Next week, we'll reveal the 3 bond ETFs experts are using to safeguard their portfolios, one of which gained 18% during the 2008 crash. Preparing now isn't just smart, it's empowering. The secrets to survival lie in these 3 ETFs, and they could change everything. Hit subscribe and turn on notifications to stay ahead.